Okay, so I guess we'll give it a go as our clients from across EMEA continue to join. So good afternoon and good morning, ladies and gentlemen who have joined this call. This is Aisha Abbas with you again. I am Head Affluent and Wealth Solutions for EMEA here at Stanchart, and I thank you first of all very much for taking the time to join us here again today. We met last week amidst some of the developments that are going through within the region. And we thought it may be a good idea to get amongst yourselves once again, just to bring you up to speed with how things are unfolding and how our views as a result of that are shaping up, and how such views are there to help you navigate through these times so that we can be able to help you preserve and grow your wealth. So thank you once again for taking the time to join us. And we're going to continue the discussion of the evolving situation in the Middle East and its implication for global markets and your portfolio positioning, as I highlighted. Since the last session, developments across parts of the region have continued to unfold. As always, our focus remains the safety and well-being of our colleagues and clients, alongside us ensuring that we maintain the stability of our operations. I'm pleased to share that we continue to support you without disruption and that we remain committed to being your trusted financial partner. At the bank, we're always by your side so that we can help you navigate through periods of uncertainty, through periods of growth, through every tide, as they say. And we continue to manage your wealth because we are here for good to support you and to help you take a go forward in the current circumstances. With that in mind, we just wanted to reconnect today to provide an update and a perspective on the recent developments. We've seen movements across equity markets, across fixed income. We've seen oil sort of rise all the way up and then correct. So a lot is happening, and the impact of that in some of the cases is quite sudden until it reaches normalization. So we thought it'll be great once again to bring in our EMEA Chief Investment Officer, Manpreet Gill, to give us his view, and also the view, of course, of Standard Chartered from a CIO perspective on how we see these asset classes moving, and if there's anything that we believe should be dialed up or dialed down within your portfolios. And obviously take your questions in a very timely way. And we are again going to make every effort to answer as many questions as possible. And those that we can't, then of course we can always come back to you. Joined with Manpreet is Pratibha, our Head of Managed Investments and Advisory, who's going to obviously be taking on live questions. And Manpreet being in the hot seat is going to help us answer those. Ladies and gentlemen, I'll remind you once again that your relationship managers, the wealth solution specialists, investment advisors, and all of us here at Standard Chartered are by your side. We are here with you. So please reach out anytime you have any queries, any questions, or any support you need, because we continue to be your trusted financial partner through these times as well. So without further ado, I'm going to now pass it on to Pratibha to again sort of bring this all together, connect us to what we talked about last time, and then Manpreet again being in the hot seat coming up to answer these questions for us. Thank you very much, and over to you, Pratibha.
Thank you so very much, Aisha. And good morning and good afternoon, everybody. It's a pleasure to be back again with everyone over here. It's as Aisha mentioned, I think it's a very rapidly evolving situation here in the Middle East. And we thought it is apt to kind of keep giving you some updates in terms of what's going on and how this kind of translates into our investment portfolios. So without further ado, thank you, Manpreet, for joining us and giving us your time on this call. Let me start. I know we spoke last week on this, but I want to just touch base so that, if there are any new people in the audience, they understand from us as to how we're looking at it from a situation sense, right? And while making investment decisions, it's always good to think in terms of scenarios. So could you maybe break down the situation in the Middle East currently, and what are the likely scenarios of the prevailing conflict, and how has it fared so far? Thanks.
Absolutely. Thanks, Pratibha, and good morning, good afternoon, everybody. Uh, I think the best way, as Pratibha sort of put it, is to look at the current scenario in situation in terms of scenarios. And look, there are many, many aspects as it is a complex situation, right? Whether you're analyzing it at a political level or any other level. But our concern, of course, when thinking about investments is, what's the channel to financial markets? Which is, to state the obvious, oil and energy prices more broadly, and what kind of scenarios of oil prices, could we expect as we go through, this current conflict. And just to sort of bring everyone to speed, I think at the start of this situation, we had put out a couple of different scenarios. And the probability we're allocating between what we call a base case scenario and the downside scenario haven't really changed, because there is a scenario that the conflict is relatively limited, at least as far as the disruption to energy supplies and hence oil prices is concerned. Whether that occurs through a relatively quick return to negotiations, or whether that happens within a matter of weeks. And we're still assigning a 70% probability to that outcome. And that's important because when we think about the market impact, it's not just about the level of oil prices we get to, but also how long they stay there. And there's a time period about whether we're talking about a few weeks or a few months becomes quite an important distinction, more than just whether oil prices go to a specific level or not. The second, the downside scenario, of course, is one where energy prices rise to high levels and stay there beyond just a few weeks for a more prolonged period, so months instead of weeks. And I think that's perhaps the downside scenario where that channel back to financial markets, does begin to hurt much more, and you see more of a cascade on to other asset classes. I think everything we've experienced so far, unfortunately been at this now in this situation for more than a week, seems to point towards that base case scenario. We are barely not even a couple of weeks into this. But I think if you think about it more narrowly from an oil price perspective, because that's what markets care about, I think that rise in oil prices so far has been relatively brief. And in fact, we've seen oil prices actually recede quite a bit in the past 24 hours or so. So that's sort of a starting point. I think looking at a disruption in energy prices that causes prices to be high for weeks rather than months, 70% probability, but of course, watching that 30% probability as we use incoming information, scenarios being the best way to analyze what is still a very, very fluid situation.
Thank you very much, Manpreet. As you rightly said, I mean, this is going on now for the last 10 odd days. And we've seen, market disruption across equities, currencies, and more recently, the sharp movement in oil. Energy markets have understandably been in focus, given that it's a Middle East situation. But how should investors interpret the recent oil moves? Is this a temporary geopolitical premium or something more structural, you think?
So I think there are a couple of different moving factors here, right? So if you think about the oil prices, before, just the context is important. So before we went into this conflict, we were in a world of excess supply. And that, of course, in our view, is what would cap oil prices to, in the range around $60. Now, since then, we've had, I'd argue, a geopolitical risk premium come in. And I think it's partly a geopolitical risk premium and partly actually a removal of certain percentage of supply from global markets, because we know there's been fairly limited, not zero, but limited, supply of crude through the Straits of Hormuz. And so that has de facto taken a double-digit percentage, supply of crude off the global sort of supply-demand picture. So I think that, together with the geopolitical risk premium, and they do overlap to some degree, I think explains why we've seen oil prices rise from those $60 ranges to initially approaching 120 for the briefest period, but more in the $85 to $90 range at the moment. I think that is sort of what got us here. And now the worries, of course, pushed us towards 120. But since then, we've seen two things happen that helped alleviate those concerns to some degree. One is we've seen lots of talk about release of strategic reserves of crude. There's talk from the G7, more recently from the IEA. But look, if we're talking weeks rather than months, that can actually be enough, to reduce some of the immediate pressure on global supply, at least for a temporary period of time. So I think there's some of that optimism coming back to markets. And of course, we saw, obviously Trump's public statements have flip-flopped. But what triggered the most recent rebound, of course, was signals from his end that, again, at least in his public comments, they sort of saw the conflict as being more time limited rather than something very, very prolonged. So I think that also helped sort of ease some of the worries in oil markets. I think Going from here, just two sort of levers I that keep a focus on. One is, of course, besides the reserves and all of that, how much flow actually restarts to the Straits of Hormuz. I think that's important. We've seen the Iranian side, at least publicly, start to make some distinctions between where the crude is going or who's carrying it. And second is, let's not forget, when we talk about excess supply, a lot of that does exist elsewhere in the Gulf at a global level. Excess supply, excess production capacity. So that, of course, can be a good thing or a bad thing, depending on where that's available and exactly how it can reach the rest of the world. So those are some of the moving parts around it. But I think it ultimately all rolls up to a big picture scenarios where, yes, one would expect oil prices to rise. The question is how far, but more importantly, for how long.
Thank you, Manpreet. I think that really puts everything into perspective, at least given what's happened so far, from all the knowledge that we have of all that's happened so far. I just wanted to bring this to our audience and our clients' attention. We have released our weekly market view, and also we've released our market watch, which is basically done in exceptional circumstances when markets are volatile. One of the key themes in the report, Manpreet, is that the higher oil prices could obviously push up inflation, right? Inflation expectations. How concerned should investors be that this might delay central bank easing? And also, at what level does oil start to change the inflation outlook materially?
So that's a good point, because I think now you're going, that channel back to financial markets. I think it helps to understand, how that can potentially become a problem or not for other asset classes. And inflation hits the nail on the head, right? Because oil prices do actually have a high correlation with market expectations of inflation in the US. And often that is the channel through which, high oil prices feed back to worries about inflation, and then equity bond markets policy, of course, then we know how they react to that. So I think a few different things here. What it means is, oil prices, but also inflation expectations is an equally important variable to watch. We've seen the sharp jump in oil prices. We haven't really seen a big jump in inflation expectations. That's the good news. Markets seem to be expecting that, our base case scenario, as opposed to the really sort of downside scenario. But it is fair to consider whether this channel and could cause central banks to reconsider how much they might actually ease policy. So recall, our base expectations is 2 to 3 Fed rate cuts going into the end of the year from the Fed, and that was really come from a place that inflation was sufficiently not a challenge that they could focus on supporting growth. The US job market is still on the softer side, and that, of course, leading us to a positive growth and earnings outcome. Now, I think if we remain in this world where the rise in oil prices is relatively short-lived and we do not see an uptick, a sustained rise in inflation expectations, that's a scenario where a central bank may very well still be able to cut rates. Right? We think not so much in the first half. Our expectation always more backloaded in the year, but that's a scenario where they could. But of course, in our 30% scenario, if we do see inflation expectations start to rise more noticeably, it would make the Fed's job much harder, because even if the labor market economic growth argues for lower rates, it'll be much harder for them to justify that when they're seeing rising pressure on the inflationary side. So ultimately, it comes back to our scenarios, put a similar probability on them, but it also comes back to emphasize the point on higher oil prices. There's no particular level. I mean, I've seen numbers like $140 or $150 thrown around. What is equally, if not more important, is how long do they stay there? A single day of $140 oil prices is not going to create inflation problems, but 3 months of $100 can have a much bigger impact.
Got it. Thank you. Maybe just in line with the inflation view and also the rate cuts, I just wanted to shift a little bit towards the bond markets, right? Are we seeing any impact in the bond markets now that a week or so has passed? And I'm particularly concerned about the GCC credits and the EMEA credits, so to speak, because we also have a lot of our clients holding long-dated GCC sovereigns, for instance. Given the elevated oil prices, rising inflation expectations, and uncertainty around Fed rate cuts at this point in time, should they be thinking about the exposure there? And is this a moment to kind of reassess duration risk in the fixed income portfolio?
So on your last question on duration, the answer is yes. But let me explain to you why we think it's worth looking at. So, if on interest rate, if you own, let's say, a dollar-denominated GCC bond, right, there are really two big picture drivers of the yield or the price movement you're seeing. The big one, of course, is US US government bonds, US treasuries, right? Because these are dollar denominated, that still sets the big baseline. And there the reaction, has been no big surprise. We've seen short-term a knee-jerk reaction. Bond yields initially rose. Now as oil prices ease, they've come off a little bit. But if you take the 10-year US government bond yield benchmark, just as an example, it's still within that 4 to 4.25 range, which has been a baseline expectation for us for a long period of time. So consistent with the view that short-term sentiment, bit of a knock, but still consistent with our base case scenario. The second source of driver of those prices or yields, of course, is how much of a premium do GCC credits pay you, the credit spread, what we call it, over and above what you can earn on a US government bond. And there, similarly, we've seen a same type of reaction. Credit spreads behave like a risk asset. In the short term, we've seen a little bit of widening, but actually not that much, at least amongst the higher quality issuers. So I think, look, this question has come up a lot. We wouldn't be excessively worried about credit quality or those two sort of main drivers at this point in time. US government in a base scenario, we don't expect yields to go up by a lot if inflation is not a challenge. And credit spreads, yes, you can have short-term volatility that that's pretty natural. But at least the high quality issuers, we wouldn't be excessively worried about credit quality. They're very, very strong sovereigns and quasi-sovereigns. The reason it comes back to your question on duration is, that actually is the crux here. Because all of what I said in the first part is great, but let's say markets do start worrying about inflation, even a little bit. It tends to impact long maturity bonds much, much more disproportionately. So if you own, let's say, to take the example at the extreme, if you own a 30-year bond, even a small uptick in inflation expectations and long-term US bond yields has a much larger price impact compared to, let's say, a 2-year bond, where that impact might be pretty marginal. Now, this is always a bit of a trade-off. Obviously, the longer maturity you go, the higher yield you earn. We know that. But to us, taking a duration decision, what sort of maturity profile is a sweet spot, is about finding we think that sweet spot on the risk-reward trade-off. In our mind, for any dollar-denominated bond, whether it's US government bonds, GCC credits, anywhere else, we continue to prefer the 5 to 7 year maturity bucket. We think that is the sweet spot in terms of earning enough additional yield by taking on a bit of duration risk, but not to take on too much, because we think when you go beyond that, you just take too much exposure to that downside scenario, because inflation expectations start creeping up. You're not so exposed at the 5 to 7 year level, but you are quite exposed at the 30 year. So to me, that would be the main thing to focus on in this environment and see if there are opportunities to rebalance.
No, thank you, Manpreet. That's, again, very useful, because I think one of the key things that we keep talking to clients constantly is that, you would probably have taken that exposure at a point in time, given the yield, etc. But I think it's a good thing to kind of keep assessing the portfolio. Of course, as long as you're still sticking to an investment plan and you're okay with the long-term hold, and you're not concerned about volatility, so to speak, I suppose that's still fine. But if not, then there has to be those assessments done on a regular basis, and considering situations, then a rebalance also is suggested. So again, I take this opportunity to let our viewers know that please reach out to your relationship managers and advisors for any such conversations, and they should be able to assess your individual portfolios to be able to give you inputs on those. Maybe I'll take this also opportunity to kind of let people know that there is a Q&A option on your screen, in the Zoom screen. Please do take the opportunity to ask any questions to Manpreet directly, and we'll pick up all of them as we go along. All right. Maybe just turning a little bit towards the currency space, Manpreet. The USD has broken above its 200-day moving average. That's something that most people kind of keep a watch on, right? You see longer-term downside risk for the dollar. Can you explain that view to clients who are seeing dollar strength right now and wondering, whether to act on it or not?
Sure. So I think our baseline view is that we will still see, dollar weakness over the course of the rest of the year. But that view was primarily predicated on a view that US interest rates would continue to ease, the whole Fed discussion we just had. And that, of course, continued to erode the US dollar's interest rate advantage compared with, most other major currencies, which either like Europe are holding rates at low levels because they've already cut, or like Japan, where interest rates are actually going up from the Bank of Japan's perspective. Now, I think what we've experienced over the past week or so has been a rebound higher in the dollar, because that's acting as a safe haven. And to some degree, in this current context, it makes sense. The US is actually fairly self-sufficient as an energy provider compared with, say, most of Europe and Asia, which are quite sensitive to energy prices because they're significant importers. So I think the break above the 200-day moving average, the extent of rebound so far, I think it's really reflecting a bit of safe haven status from that perspective. And you could argue short-term pricing out of full probability of those 2 to 3 rate cuts. But I think, look, a 200-day moving average at the end of it is just one technical signal. It's a reasonably good one, but far from a perfect one. And I think we always need to look at a broader range of indicators. If I had to look at another sort of level or technical indicator-based one, the other big one for me is on the DXY index, the dollar index. We have seen a rise, but we've not seen a rise back above 100. Right? We've seen a rebound back, but holding well below that 99.5 to 100 level. And I think I'd be a little bit more concerned if we had the 200-day moving average break and we saw firm break above 100 back in that 100 to 110 range. But so far, so good. We haven't seen that, right? And I think that is maybe another indicator that markets so far are in our base case scenario frame, as opposed to thinking about some of the more worst case extremes. So look, to me, I think what's on the other side of the equation matters. So I think the dollar short term can be a good, safe haven and specific dollar denominated assets that I'm sure we'll discuss. But I think on the other side, that dollar strength is having a disproportionate impact. And I think on some of the more significant importers, particularly in Asia, economies which are quite sensitive to imported energy prices, I think is where one should expect a slightly more disproportionate impact. While others, for example, versus major European currencies or low borrowing cost currencies is where the impact has been more muted. But I think it's the jump in the dollar, I think, is what we're seeing across currency pairs.
Thank you, Manpreet. So, I'm going to pick up on another topic that was covered in the weekly view as well. Your strategy is to maintain core pro-risk allocations while building hedges. For a client who's listening today, and I also pick up a question from the Q&A, if they're nervous and tempted to go defensive, what's the message to them? Because if you already see some of the questions that are coming through, they're saying that, we should expect high inflation and an increase in oil prices. These will definitely affect our investments. Is it therefore safe to continue investing considering the high risk of investment? So I think that the hedges question as well as this maybe go hand in hand, so it can help answer.
No, it's perfectly natural to be nervous at these points in time because, of course, there are scenarios where this can hurt investments a little bit more. But I think it's equally important to consider the scenarios, and there are many, where it does not have a lasting impact on portfolios. And these are the kind of markets where you tend to have the most stress, but you also tend to get the best opportunities, right? You don't get great opportunities in calm markets that are rising, in a straight line. So I think the way we think about it is, and I'm coming back to those scenarios, right? Because there are two ways one can naturally respond. One is to say, listen, my core portfolio allocation, if it's pro risk, I just don't want that, let's change it. I guess that's a much bigger decision. But there's a second one that says, I don't want to change that, but nothing wrong in adding a few hedges in addition, which can help smoothen the mark-to-market impact if you expect it to be relatively short-lived, as would be the case in our base scenario. I think so far our approach has been to say, look, it looks like we're in a base scenario, so we don't really want to touch those long-term allocations, that you get tied into market timing and the risk of getting whipsawed, selling after, many asset classes have fallen and potentially buying them back when they go up by much more than the level you sold them at. But of course, it's prudent to have hedges even a base case scenario. So our approach right now is not to touch the long-term portfolios, but add a few hedges. So I think hedges, of course, oil prices being the main challenge. We've obviously looked at energy sector equities, which have reasonably high correlation with oil prices. And obviously these sort of pullbacks in oil prices might be good opportunities to do that. We like inflation-protected bonds. So it comes to the conversation around, look, if this becomes a bigger problem, we'll see it in inflation expectations first. So inflation-protected bonds can offer one sort of direct hedge against that. And of course, there are the more traditional hedges like gold, right, which we like for a variety of very different reasons. We liked it before this current conflict, but those can be slightly longer-term hedges as well. The only safe haven I'd be careful about is actually the Japanese yen. Because while normally that does tend to also behave like a safe haven, in this case, we don't expect it to because Japan is quite a big energy importer. So it's quite a high degree of sensitivity to the downside if energy prices rise. So perhaps maybe not that one, but the others, of course, can make sense. I think to really consider making changes to long-term allocations, we'd have to see much more significant signs that this is going down our downside scenario, which, to be honest, so far we're not seeing that, at least, especially if you think about the market reaction broadly at this point in time. And I'd say equally important, and this might sound difficult in this current environment, is to keep one eye out to say, look, but are any opportunities being created? And you'd be surprised by how many individual client conversations I've had to say, okay, I get the risk, I'm worried about them, I won't talk about hedges, but also, hey, things will get cheaper. What should I be thinking about buying? Right. And I think it's important to just keep that balance.
Oh, fantastic. I think, yeah, absolutely. We always say that, when markets go down, it's on sale. And that's the only time where we don't really see people coming at it. So, yeah, absolutely a great point. I'm just going to pick up on your point around gold, right? And if you actually go back to the onset of the conflict, gold at that point surged. But and then people have possibly taken off some profit off the table. You maintain a 3-month target of about $5,250 per ounce. Is this still a tactical trade or a structural positioning? And what's your advice to clients who probably haven't yet invested in gold? And I'll just follow through that, sorry, with a question around gold as well from that I just saw. How do you interpret the reaction of gold prices to the prospect of war, which is, I think, similar to what I've asked? But how do you also expect gold to perform in a potential post-war environment?
So, look, a lot of great questions out there, right? I think let's start with why we like gold, right? And that goes beyond the conflict. To us, the most important support for gold is long-term central bank demand. Right? We've been overweight gold for more than a couple of quarters now. It's been a great contributor to the returns of our model portfolios. But our view has been that what's really continues to drive gold higher, whether it's 5250, 5350 on our longer term expectations. And look, we recognize price targets to some degree have been a catch-up process across the industry because we're well into uncharted territory. But what's more important than a price level is to see, look, is the driver in place? Are central banks still buying? From whatever data we can see, it does look like that demand is still there. And that's why we maintain that overweight. We'd be quite happy to own gold. Now, in the short term, we have seen gold actually, be a little sideways, perhaps pull back a little bit last few days, which might seem somewhat counterintuitive. But in my mind, there are two reasons for that. Number one is if you have higher bond yields, if you have a stronger dollar, those tend to work against gold in the short term. And that to some degree explains, that reluctance of gold to rise. And second is, look, gold is coming off quite a big surge, short-lived surge, a few weeks ago. So in our mind, gold was already set for a short period of sideways consolidation before we start the next sort of leg higher, because that excessive positioning, as that washes out. And I think that, of course, naturally tends to limit, big new surges in gold. So those, to my mind, are sort of the limitations, which is why, if you're looking for something very short term, I'd rather look for an asset class that's closely correlated to the oil price, which gold does not do that. But if I look beyond that, right, if I think about the long-term drivers for gold, which is central bank demand, and if I think about gold's, alternative role as, a big picture safe haven, something that does well when you especially when worried about high inflation or stagflationary scenarios, that's why we'd still like gold, keeping that overweight. And I think if we see sort of this flat line or even pullbacks towards the $5,000 level, to me, those would be great opportunities for anyone who doesn't have, that 5 to 7% allocation to gold.
Thank you, Manpreet. I'm seeing some very interesting questions coming up on our Q&A portal. Maybe let me just pick up one from there. So markets appear to be pricing the Iran-US tensions as a short-term geopolitical event. In your view, what specific developments would signal a structural shift in global energy markets that would require a more permanent reallocation of portfolios towards commodities, energy equities, or inflation hedging assets?
No, that's a great question. I think that's where the scenario analysis way of thinking can really help, right? And look, probabilities are not going to be most investors' favorite approach, because obviously everyone wants a certain answer one way or the other. But actually, this is a great example of where they can help to say, look, we started from a 70-30 probability or base case downside. But if you start to see events that, for example, start to push that 30% higher towards 35, 40, or things start to look like we're heading in that direction, then obviously portfolio allocations and weights can start to change, more towards that scenario. So I don't think we're going to get one or two big events that say, okay, where there's a binary outcome, base case, we've now gone the other way. I think what's going to make this hard, as is always is the case, that's going to be a slightly more gradual and continuous process, right? Which is why scenario analysis thinking helps, and thinking about, okay, am I adding hedges? Am I starting making incremental portfolio allocations? I think that's the way, it's going to have to work out. So it's really about being reactive, having the framework in place, scenarios, adding new information as it comes in, and having those regular conversations with your advisors, right? I think that's going to be more useful. Um, but I think I suppose if I really had to push myself to one or two factors, I think it's a high oil prices, but also if they look like they're staying there, I think that's going to be a key one. And things that feed into that, right? How much physical supply is either still on the table or off the table. And if you just think through the headlines of the last couple of days, you could say on the negative side, we've seen obviously some attacks on refineries, limited shipping. But then on the positive side, we have seen, the Iranian side signal that some shipping is actually still being allowed through, which actually argues more for a base case as opposed to, the alternative. So those are the kind of, news inputs we're saying. I think the big one is US market expectations of inflation, because those have been really well behaved. If we start to see those rise, A, we'll hear about it in the financial media, and B, I think that is where you'll start to see markets react in a very different way to what we've seen so far. And that may be a point where we may have to reassess whether we're still confident in what we're seeing, or whether we want to make some longer term changes to portfolios.
Absolutely. I think the US inflation figures are due tonight as well. So I think it's a good one to keep a watch on. I have another one on inflation again, and maybe slight twist to it is that with 20% of global oil and LNG supply currently offline, are we looking at a permanent shift in a higher for longer interest rate path? And how does this change your valuation models for high growth tech sectors that were expected to lead this year?
Great question, I think. Look, I think you're right, 20% off, but let's not forget that some of that may very well come back, right? And there are a few offsetting factors here, right? Number one is we've seen, within the region itself, some reallocation. I mean, we've just been following news on Saudi and how they're trying to restart more supply to the East-West pipeline, for example. Individual decisions like that can help. Obviously, we don't know how the conflict itself will evolve. Literally, every day is different. It could be a lot better. It could be a lot worse, right? So if you wake up one morning and discover the two sides are willing to talk, that would change the outlook completely. Or some deal is agreed on at least shipping. But I think the third thing I'd say is obviously the conversation on release of strategic reserves. Because at the end of the day, markets are simple creatures, right? It's demand and supply. We're discussing is taking what has recent events have taken some supply of market, but obviously policy levers can bring some of that back. So I think we just need to balance those out. I don't think we're at a point where long-term structural flows are necessarily changing, where whatever I've read from specialists in the energy space seem to suggest that we're still in that phase of, yes, supply has been disrupted, there have been some shutdowns, but technically we're still in a place where should we get a more benign outcome within a matter of weeks rather than months, it's a large part of supply that's been cut off can still plausibly come back. Obviously, that becomes harder the longer this drags on. If we're saying 3 to 6 months, then yes, it will take much, much longer for a lot of that supply to come back. So I think that's still the way I think about it. On the tech industry, I think that's a really great point, right? Because I think there are two offsetting factors here. Tech industry tends to be high beta. So if we do see a broader risk off if markets worry about our downside scenario, then one would expect tech to be impacted. Not because there's anything wrong in tech, but those kind of environments tend to see a broad risk asset readjustment or repricing. But to be honest, the reason I think the tech overweight still makes sense is that we have already seen some repricing, because tech has been through a couple of different questions about the extent of capex, different winners and losers within the technology sector. So especially tech, if we're looking at less of the software, but more of the semiconductors, more of the internet subsectors, to my mind, those, the focus is going more and more to how well earnings are performing in those sectors. And the earnings growth picture remains a very, very strong one. So yes, short-term volatility, these are external shocks, but I think intrinsically from the sector perspective, keeping a focus on earnings growth, I think is still the best way to approach it, and I think will still offer a very, very positive signal. The other thing we can do, of course, is let's not forget technology. There are different ways to access the same story. So within the US, we looked at different ways of accessing it. So for example, the utility sector, it's a small share, but actually seeing some fallout from tech through the energy demand sector, and non-US markets, right? So Chinese equities, for example, we favor the Hang Seng Technology Index for some time. to some degree a similar theme in a slightly different way, but obviously at a very different valuation and in today's world geopolitical backdrop. These are different ways of accessing a theme we think is still pretty valid.
Thank you, Manpreet. That's very, very useful. I'm actually going to stick with the equity space for a bit now, since we've not really covered a lot of that. You've been bullish on US aerospace and defense equities, and we've actually seen defense doing fairly well over the last few quarters across Europe as well as the US. Obviously, that's going to be a key beneficiary of this environment. With projected EPS growth of over 14% in 26 and possibly nearly 20% in 2027, is it too late to add to that sector, or is there still a meaningful upside in that sector?
No, we don't think it's too late, and I can see where some of that is coming from, because yes, we have seen quite a bit of performance come to the sector in absolute terms, but I think the clue really sits in that earnings expectation number you cited, right? Because at the end of the day, long run equities should reflect the extent of earnings growth we get in the underlying companies, and into our mind, the earnings growth expectation, both actual delivered and what's expected now, still paints a very, very strong picture, and that's one part of it. And then if you think about the broader catalyst, right, it's tempting to look at individual conflicts such as the one we're experiencing. But if you roll back over some of our own outlooks for the past 2, 3, 4 years, the sides of geopolitics we've covered, we do seem to be shifting to a world where individual markets are spending more and more, individual players are spending more and more on aerospace and defense. So for the reason and logic is different in each scenario, but we think there's a little bit of a structural shift happening there. And that's why when you put that against the nuts and bolts of equity investing, which is to say, okay, what's the earnings growth do I expect? We think it's not too late. And as an opportunistic idea on a standalone basis, it's something we think is still attractive.
Thank you, Manpreet. Again, sticking with equities, we remain positive on China and India as well over the next 6 to 12 months, despite year-to-date underperformance. For China, what are the earnings catalysts that you're watching in March? And for India, how much of its recovery is dependent on oil prices coming down?
So for China, I think the energy price sensitivity, anything, is a little bit less, at least from an equity market perspective, because we think, just looking at, again, the nature of listed companies, it's actually technology sector earnings, internet sector earnings, we think are the big catalyst here, because we have seen, again, a variety of pressures, but we do think that sector will continue to deliver strong earnings. And as we go through the current earnings season, we think that will give the market much more confidence. And that's why in China, we're meeting this barbell. I mean, yes, we have a defensive idea in terms of state-owned dividend-paying SOEs, but it's really the technology sector, the Hang Seng Technology Index. We think the earnings is enough to continue driving that. India, no doubt, as an economy, as a market, has always been more oil price sensitive. So we do think that we may need to get past the worst of the immediate market concerns to unlock some of the performance. But again, what's interesting about Indian equities is the actual market reaction, even on the biggest down day, when oil first was trying to approach $120, was actually surprisingly muted, right? And in fact, it's far more muted compared to North Asian markets like Japan or Korea or Taiwan equities, which fell by much, much more. And I think part of that is reflecting the fact that Indian equities have already underperformed Asia Japan by quite a spectacular amount, in recent quarters in the past calendar year. So there's quite a bit of bad news consensus underweight in the price, and I think that's really dampening the downside. So yes, while we might need a removal of these headwinds to really unlock the performance, we do think this is a great environment to start to build some of that exposure, because when you see markets underperform to such a large degree, when you have so much consensus underweight, often you don't need great news for markets to underperform, you just need less bad news, and that's often enough to unlock performance.
Yeah, I totally get that. Thank you. Maybe just a couple of questions around currency. I do see some building up on currencies. For globally diversified investors, would you recommend reducing USD concentration or simply increasing exposure to other currencies and international markets? And there's another one in line with that, asking about what's our view on the AUD and US dollar? And again, another question around this where it says, should we kind of stop investing in dollar largely and start to diversify across other currencies?
So I think the answer here is really to diversify, right? I don't think we should stop investing in US dollars. I mean, that would be quite an extreme decision. And let's not forget the vast majority of global investable assets are still dollar denominated. But I think the key question is, okay, what should be the ratio of dollar to non-dollar, investments in one's portfolio? And some of that is, yes, what you can see and feel that in the actual investment itself. So, for example, buying Aussie dollar bonds would be directly non-dollar. But actually, if you own global equities, or even if you own US equities, you already have a lot of non-dollar exposure. Right. So just to give an example, if you go and buy the S&P 500, you already about 60% US dollar, 40% non-US dollar, because that's what the earning stream of the underlying companies already reflects. Right? So you don't need to make any additional active decision. We took a look at our own globally diversified portfolios, and what we found is that our diversified sort of balanced portfolio, once you account for the fact that equities already give you some natural exposure, we're at about a 50-50 ratio between US dollar and non-US dollar, de facto currency exposure. So, that may be a great starting point. Obviously, everyone's situation is going to be slightly different. But yes, trying to at least have an active eye on that to say, wait, what is my real dollar versus non-dollar exposure? That's the part which you can see in terms of the currency symbol in front of your investment, but there's also a part you can't see where you might see an equity investment, which is denominated in dollars, but what's the real exposure behind that? And that's what the conversation with your advisor, right? So that is something I think we would do. Now, within that context, the Aussie dollar is actually quite interesting, right? It is one of the currencies we do like, even in our, even in a stable to slightly stronger dollar environment, because I think it's emerging as one of the few currencies where the central bank is moving away from cutting rates to going back towards potentially raising interest rates because inflation's coming back as a bit of a challenge. The other interesting thing with the Aussie dollar is it is quite correlated to several commodity prices. Australia tends to be a big commodity exporter, and particularly with asset classes like gold. And we think that combination will provide some support to the currency. So whether it's just on the currency pair itself or Aussie denominated bonds, those are worth considering if you're looking to diversify, currency exposure of one's portfolio.
Thank you, Manpreet. Let me just give you a small break. I do see some questions around our advice given on our falling mutual fund portfolio prices due to the Middle East crisis and potential ROI sliding to negative returns. What should investors do now? And there are a couple of clients who are asking for similar things. So maybe let me try and attempt to answer that, right? I think all assets which are being invested in capital markets will in some way or the other be affected by the price movements in the global markets. It all depends, of course, on where the underlying assets of these mutual funds are invested. As we constantly keep speaking about this, volatility is something that just it's a matter of time that you kind of ride out that volatility in global markets. And typically, what we've seen in volatile times is that what we normally suggest to most of our clients is to keep emotions at bay, revisit the investment plan, and try and look at it from a longer term perspective. Because if you look back historically in any of the situations in the past where there has been significant volatility in the market, take for instance COVID, take for instance the GFC, while the duration is of course of concern, each situation could have a different duration in terms of the recovery period. But eventually markets have been resilient and have picked up over a period of time. And eventually the underlying assets will reflect those prices as well. And that's what will ultimately show up in your mutual fund portfolio. The one thing to keep in mind is that mutual funds are a broad, diversified set of assets. You are not invested in a single instrument or a single asset. So even if like one asset hasn't really done very well, there are numerous other assets that can actually make up for that loss. So I would only suggest that you go back to the investment plan, revisit that investment plan with your advisor, preferably, because then they can actually look at it from a case-to-case basis, look at it from a fund-to-fund perspective, of course. I mean, it could be just a plain vanilla fixed income fund, or it could be a multi-asset fund, and each of those could, react and differ in its, return outlay. So I would suggest that maybe just revisit it with your advisor and see if there has to be a rebalance if there is a rebalancing opportunity in the portfolio currently, and then take suitable calls on that action. It's very possibly very difficult to kind of assess on a very broad basis, but typically mutual funds should have a more diversified approach, so you are better off in mutual funds to a large extent. Maybe one other question back to you, Manpreet, around currencies is, there is a cross-currency ask over here from a GBP perspective. One, of course, is that what is the impact of the war on GBP crosses, but specifically in concern with the GBP JPY cross. I don't know if it's too specific of an answer, but if you can maybe cover off some portion.
Sure. No, I think, look, our views on GBP are perhaps not that dramatically different, I guess, on our views on crosses versus US dollar. And I'll explain to you where I'm coming from, right? Because one good way to think about it is, okay, let's think about what's the impact on cable, so GBP USD, and then see we can use our views on other currency pairs versus the US dollar. Now, for GBP, actually, our views are relatively range-bound one, sort of heading towards 133, 134. And the reason for that is we think that there are obviously offsetting factors here. We do think compared to the US, the economic outlook in the UK is perhaps incrementally that much more challenging, arguing for incrementally that much more policy easing from the central bank. And that, of course, is GBP negative. I think the question is, how much that GBP negativity holds up against our view of dollar weakness. And on assuming in our base case we do get a dollar weakness rest of the year, we should see the two largely cancel each other out. And I think that's why GBP USD may not move as much as the economic and interest rate outlook in the UK standalone might argue for. But look, in the short term, I think I'd say two things on the dollar and the yen pairs, right? Number one is that I think the big determinant of what GBP USD does is not so much the GBP side, but entirely what the US dollar does, right? Because base case scenario, we've got the dollar get stronger short term, but if we stay in a base case scenario, then we get dollar weakness as we start to extend the time horizon, we go back to the world where we were before. But of course, in that downside scenario, I think its dollar strength will dominate what's happening in GBP or any other major currency, right? So I think that's one part of it. I think versus yen, look, on the levels, look, I don't have those at the tip of my fingers, but we do publish our projected short-term views on all these crosses in our daily on the second page. So please do take a look at those. We have a bunch of GBP crosses over there. But I think if you sort of take that GBP range-bound GBP USD view for a moment, I think on yen we do worry about a jump in yen strength at some point in the next 12 months. And that's simply because the Bank of Japan is one of the few central banks that's still slowly but very steadily raising interest rates. And that starts to close the interest rate gap with most other major currencies, including GBP, if the UK keeps cutting interest rates. But I think before we get to that long-term view, we do have a lot of yen weakness pressures, especially in terms of how much the government wants to spend, sort of standing between now and then. So we might get a weaker yen before we get a stronger yen. But I think that view applies equally against sterling as it does against the dollar.
Thanks, Manpreet. Again, going into a bit of specifics, right? There is a question around if we can explain our expectations around the Signature CIO funds, and of course, more specifically, the Signature CIO Growth Fund. Any rebalancing expected from the fund managers in light of the ongoing Middle East tension? Please feel free to cover as much as possible in terms of the views used within, and then I can cover off the product as well.
Sure. Look, at the end of the day, a lot of the views for all of these ultimately come from our model portfolios, are the house views from the CIO office, right? So I think the question is essentially the same one as asking us, look, will we consider making any changes to our tactical asset allocation? Because that's what will reflect in portfolios down the line, including funds like these. And I think that comes back to where we started to say, look, if we think in terms of different scenarios, if we truly in our base case scenario, then the answer is no. We should expect some short-term mark-to-market volatility because we've seen that weakness in Asian equities. We have seen a bit of volatility across other major asset classes. But then the spirit of not trying to excessively time markets and multi-asset, well-diversified funds, that doesn't necessitate, going out and changing allocations too rapidly. Instead, we'd consider keeping, those sort of strategies, but instead adding some of the hedges we discussed, right? That might be a way to smoothen the journey at a total portfolio level. I think that may be a more prudent approach. But at the end of the day, let's not forget these are already very, very well diversified. Fully invested, but well diversified. So some mark-to-market volatility is to be expected because these are fully invested. But diversification, the really boring stuff, we get tired of speaking about. I think times like these that's where it ends up being super valuable. And I think we've seen that across our model portfolios as well.
Thank you very much, Manpreet. I think, you've covered all of it, right? That is, those are portfolios that we call our foundation portfolios, given the extent to which the diversification, kind of reaches. It's across our asset allocation. And if anybody were to try and allocate across all the various asset classes and sub-asset classes, that would be quite a task. And this one does that, easily for our clients, and most importantly, rebalances the portfolio as and when you make those changes in terms of the views on asset classes. So I think just possibly the best situation to be into at the current time as well. Let me just go back to the questions here. And, we spoke a little bit about the GCC sovereigns and the general Middle Eastern bonds, etc. There is one question around how do we expect liquidity positions in the UAE? I'm connecting it particularly to the bond markets, but if you have a broader view on that.
So I think when it comes to liquidity, and I'm specifically referring to bond markets here, right? I think there's a lot we can learn from past market stress events over the past couple of decades, right? And we've had many, many of those. So quite a few learnings. And I think if I look back to my experience in Asia dollar bond markets particularly, I think what's interesting is that when you have a big crisis event, whatever that crisis might be, you do tend to see some impact on liquidity. Liquidity tends to drop away, and you tend to see even big benchmark names can be a little bit harder to trade. But that tends to last for a relatively short period of time, because unless there's any intrinsic challenges with the issuers, that's more a mark for sort of one of those classic near-term, short-term reactions where you tend to see prices ultimately come back. Let's not forget, there's always a market price for every scenario. Right, that's just the nature of markets, and they usually get to that point eventually, even if there are a couple of days where liquidity might be a bit more challenging. So I think it comes back to when you put in the GCC context, right? I mean, if you look at the higher quality GCC sovereigns and sovereign-linked names, we're quite comfortable with the credit quality, extremely high quality credits. If there's extended period of stress around the context of our scenarios, credit quality would not be the first thing we'd be excessively concerned about. But it's natural for that environment for people to freeze up temporarily and say, okay, what does this mean? Should spreads be a little bit wider? And the starting point, obviously, for valuations is that spreads have been on the expensive side, and we've seen sort of markets have to adjust to that. But I think, to me, liquidity tends to be a more short-term challenge. A little bit like the sunlight right now. I'm hoping that is a little bit of a short-term challenge. Apologies for that video. Seem to have picked that time of day, but liquidity challenges tend to be the kind that pass relatively quickly. The only time they tend to become more of a challenge if the underlying issuer is facing some real and significant challenges. And you do see that from time to time with much riskier, high yield issuers. We saw it in the China property sector, for example, in the high yield, stressed sort of end of the spectrum. But I don't think that's a scenario you'd expect with high quality GCC.
Thank you, Manpreet. I think we just about have time for a couple of more questions. So I'm going to pick off a few from the list. Is there a scenario where whatever is happening in Iran can actually be positive for the markets, and in terms of investment or reallocation decisions, from what is happening? So I guess a little bit to the opportunities that you were talking about earlier. Maybe we can summarize that.
No, absolutely, and I think. If I were to put aside all the worries for a moment, right, there are many, many things we can worry about, but sort of put on my opportunistic hat saying, okay, let's say the base case really does play out, right? And one has cash to deploy or reallocate, then you're almost looking at the market saying, okay, we're going to get some volatility, some pullbacks, but where am I hunting for opportunities? And there are a few places that come up, right, as potential opportunities. So in the very short term, if we have a period of stress, even just a couple of weeks, one can see that oil correlated assets have done very well. And actually, we've seen that within the GCC, just as a factual example, right, of large sort of oil related corporations, we've actually seen quite a bit of support, in terms of the market price at an equity level, despite everything else that's going on. And we've seen that in market, a good example in every equity market. Second is that, look, we've seen Asian equities. We like Asian equities for a variety of reasons, right? And that's an asset class we expect should do well, not only for its own earnings growth, but also in a weak dollar world, Asian equities tend to do very, very well. But obviously, in the short term, with this whole worries about oil markets, we've seen quite a bit of pullback, and we may not be through the peak of the concerns there. But that would be another example where Asian equities do very well, offer quite a bit of opportunity, because one should expect to see worries, in the short term, if oil prices do rise. But if we're right about a base case, those type of pullbacks would be great buying opportunities, bit like what we discussed on Indian equities. And third is, of course, we discussed gold as well, right? Because gold, we like it for a variety of reasons. It should actually act as a hedge, but actually you've seen the price not go very, very far. And we know a lot of people are still under allocated to gold, but that's obviously a third area to consider as an opportunity. So I've only touched 3 examples. There are many, many more implicit in our views, but I think it's a great way of thinking, right? I think it helps to almost have separate discussion to mentally separate them, because the natural reaction at times like these is to be concerned. And that's sort of one half the conversation, but it does help to sort of step back and say, okay, if I'm okay on that front, and hedges, that's where hedges can help. How do I make sure I'm also taking advantage of opportunities thrown up by the market? And maybe one last one I'll mention is on the GCC credits, right? If these are high quality credits, but spreads are getting wider, then actually, that becomes a great opportunity to add compared with the last couple of quarters where they've actually just been quite expensive from a market valuation perspective.
Thank you very much, Manpreet. That has been extremely insightful and very, very useful for useful perspectives largely, right? I think incredibly clear in terms of what action points that some of us can take. I do know that there are multiple other questions on the Q&A box now, which we haven't really been able to get at, but we will try and attempt to get to these investor clients and see how best to address those questions, and also see if we can reach out to your RMs and advisors to be able to connect and give you the best answer possible. But just to bring it back together for everyone in terms of a summary of what we've discussed today, our base case remains that the conflict will be relatively short-lived. The market impact so far has been contained, and the strategy to maintain core pro-risk positions while building targeted hedges, particularly in defense equities, US energy sector, TIPS, and gold, is what we prefer to do at this point in time. So with that, thank you again, Manpreet, for the very insightful session. And thank you to all our listeners to be listening in, dialing in at a time like this, and asking us your questions. We will definitely get back to you in terms of how best to address some of the ones that haven't been answered as yet. But again, thank you once again for all your interest, and do keep safe. Thank you.